introduce yourself, your background, and what is your venture capital is focusing on recently in the space? Let's start with Haseeb.
So I'm Haseeb. I'm one of the managing partners at Dragonfly, which is a global crypto investment firm. Right now, at the present moment, I think the big themes that we're paying attention to are like real-world assets. We're looking a lot at L2s and kind of the L2 ecosystem, whether it's DA or whether it's the L2s themselves. We're also spending a lot of time looking at institutional infrastructure as the market is shifting more away from retail, more institution-heavy. That's one of the big themes that we're noticing, especially post-FTX. So we look at everything, but those are the themes that I think I've been spending more time on over the last couple months.
I'm Carl, CTO investment partner, Shima Capital. We are a generalist fund, just like Dragonfly. Though I don't personally come from a finance background, I'm an engineer. So my primary focus is infrastructure, layer 1, layer 2, data, automation, ZK. But also part of my interest is in DeFi. Specifically, these days we look at RWAs as well, because I think generally speaking, that will really move the needle for the ecosystem. And yeah, that's kind of our focus today.
And last but not least, we have Tony representing Foresight Ventures.
Yeah, hi guys, I'm Tony from Foresight Ventures. Our fund is about 400 million today. We're a generalist fund, like Dragonfly, like Shima. We spend quite a bit of time looking at infrastructure these days, middleware, as well as applications. My personal preference today, I look at a lot of applications. I used to invest in Web 2. I was at Sequoia China investing a lot of fintech, consumer internet plays. So yeah, so my focus here, I spend a lot of time looking at applications, kind of what gaming, social, what can kind of bring the next 100 million users into the space.
So my second question is that, we receive tons of decks all the time, right? Especially in bull market, it get crazy, and even in bear market, we still see hundreds of projects every week. So how do you choose the top projects to invest, and what are the key qualities you look for?
I mean, so a deck is supposed to be sort of like the business card for a company, right? So it's supposed to encapsulate everything important in a very condensed way so that I can understand very quickly what you're building. If I get a deck into my inbox, well, I'll tell you, for any VC, the honest answer is that if I just get a cold deck, I'm probably not going to read it. Almost always, if you want to actually get in touch with the VC, you need some kind of introduction from somebody they know. If you work in crypto, that means that you have the entire world, literally anybody in the world who's looking to get investment, cold emailing you every single day. So anytime I open my inbox, if I literally did not have any filters in my inbox, I would have hundreds of unread emails every morning, and I do not have time to read through hundreds of random pitches for random things all around the world. And so every VC, fundamentally the first filter is, do you know somebody I know who I believe is competent, who can introduce you to me and say, you should take this meeting, or you should meet this person, or you should look at this deck. Now, once I actually get a deck, most important thing is that I need to quickly understand what you're building. If it takes half the deck for you to explain that crypto is going to change the world and isn't DeFi amazing, and I'm like, okay, I already know that. I'm a crypto VC. I'm in this industry too. Tell me what you're building. And make it very, very clear what is different about what you're building from what already exists. So this is one of the things that I think most commonly will make me just completely lose interest in a deck, is if they themselves don't understand what's interesting about what they're building. So show that you, 1, get to the point, 2, explain clearly what you're building, 3, explain why it's different and why it's new, and then 4, show your credibility. And that credibility can come from what you've built before, what you've already built, in terms of what progress you've made on the product. If there's traction, show me the traction. Those things are basically what's going to get me through a deck and get me excited by the end of it to want to take a meeting or potentially to want to invest.
I personally have a different way of kind of looking at decks, right? Primarily, I personally have a couple of theses I like to go with, right? So for example, today, I generally think DeFi is not secure, right? And the current architectural design of EVM cannot be made into a secure environment. So following that type of thought, I would generally start looking at decks that fall into this type of category, right? We do have some type of processing on the back end where we say, okay, these are the deals that have to do with these type of technologies and so forth, right? So I would start looking at these type of decks and try to see if there's anyone that's solving the problem in a meaningful way, right? So that's one way of how I look at decks. Once you start looking at the deck, right, you see crazy stuff. Sometimes the deck is 55 pages long. they want to talk about their team, they want to talk about the landscape, they want to talk about the problem. Some of the decks are only 5 to 6 pages. We do outreach sometimes across the entire spectrum, right? It doesn't really matter what kind of deck this is, as long as you're actually communicating effectively, right? There's different strategies. Some of the teams prefer to be very open about communication. They talk about the round size. They talk about how they're solving the problem, right? And sometimes they're just teasing you, five-page deck, but they describe the problem really well. So for a thesis-driven investment, we will actually proactively go out there and look for the type of projects that we think are going to solve the problem. And the second category is opportunistic, right? Meaning, hey, we're not really looking for this type of projects. They show up and they move the needle for the industry, right? For those type of projects, definitely, absolutely, we don't really look at the code outreach. We need some form of existing relationship to kind of start looking at the decks and potentially engage with the founders.
So I've looked at probably thousands of decks over the past few years, right? In Web 2 and Web 3, I think the decks that kind of captured my attention the most were the ones that provided very vital information about the background of the founder, the team, the motivation. A lot of them, I think, like because we typically deal in more earlier stages where the idea is thought out to a certain extent, and the go-to-market kind of has a certain strategy, but like it's still not going to be very fleshed out because given the early stage of the company. What we tend to look for, like we want to see more conviction in the team that has a similar background or has a very kind of strong hook that they have in why they can create this product and why they want to create this product.
So the next topic is understanding risks. We know there are tons of risks out there, especially for decentralization and for Web3 investment, right? Like last year we had Luna happen, FTX happen, a lot of sad stories. So how do you guys balance out the risk aspects with the potential return that you've got from the investment?
The question is, which risks do you want to be taking? Generally speaking, when you're looking at an early stage company, it's okay to have technology risk. It's okay to have some team risk. It's okay to have execution risk. But as you get later and later in the development of a startup, those risks have to start kind of wearing away. And the core aspects of what you're doing, if you're building a technology company, that technology risk better go away by your Series A or Series B, right? I better know that, like, yeah, you can actually ship a ZK rollup, or you can actually make, a blockchain that is twice as scalable as your competitor, right? If that's what you're claiming, and you can't get there by, Series A or Series B, then at a certain point you're no longer investable because that risk has not been mitigated. At the very earliest stages, it's totally okay to have risks. It's totally okay to have big question marks that you don't know the answer to yet. The important thing, at least from my perspective as an investor, is that you need to understand that about your own startup. If you do not understand the risks that you are taking and you don't see them clearly, that is what's going to make me lose confidence that you are going to be able to manage those risks. If you can't own up and say very clearly, yes, the biggest problem with my startup is that there's this risk. If I have a different opinion than you do of what that biggest risk is, then that tells me that you don't understand your startup very well, or worse yet, that you might be deluding yourself about what are your skill sets and what are the real risks that are in front of you. And the one thing about crypto that we've all learned collectively as an industry, you really don't want to back people who are deluding themselves because it ends badly for everybody. So those, I think, that's more or less how I think about risk. I don't like VCs who are too precious about risk because everything in crypto is risky. Right? Of course, Bitcoin's risky. The whole industry is risky. We don't know exactly how any of this is going to play out. But as a startup founder, you must have mastery over the risks that are in front of you in the thing that you're building.
We do a bunch of infrastructure deals, right? Because the upside is there relatively compared to application level deals. But one of the risks within the infrastructure deals is that there's too much noise. For example, we're going to be able to perform limitless scalability, and so forth, which to me, the founders are not realizing that what they're promising is not possible, right? So to me, talking to founders and understanding these type of risks is very important because not only I need to understand the problem, the founders also need to understand what are the risks when they're executing these type of projects, right? So I'm being very pinpointed at infrastructure deals because I think it's one of the more difficult verticals to kind of flush out, right? And specifically, these days are a little better because it's a better market. You don't have as much noise as before, but during the bull market, every single day there's going to be an infrastructure deal that is promising things that are just not possible, right? Now, sometimes the founders are coming from a place of malice. We will not engage, right, with these type of founders. But sometimes the founders really believe that they are building something that's fantastic. And that's where we need to be able to kind of talk through your risk mitigation strategy, right? Sometimes there are hardware projects that are dependent on other hardware that are not yet ready. Apple took that risk, right? When Apple first came out with that iPhone, they did not have a GPU that was able to power the graphics of it, right? Steve Jobs was counting on the fact that by the time they released the iPhone, or right before they release the iPhone, they will have such technology, right? So these are the type of risks we're dealing every day, and it's just, what is the founder's ability to kind of realize that these are the risks? So.
Yeah, I think Haseeb put it really nicely. He pretty much stole the words out of my mouth. Like, I couldn't put it as good as he spoke it, but I think the biggest question these days, like when we speak to founders, is what is the risk of this? Like, what are the main risks you see for your protocol to not take off, right? Like, that's a question I think every VC asks in every meeting with their potential portfolio companies. Learning to assess risk as a founder is probably the number one, the number one like goal that you need to have, because like VCs need to understand that you know what you're doing, you've thought through exactly what you're building, and taken like the time to understand like what the steps and what the kind of risks that might happen in this entire journey.
So my next topic is on the evolution of Web3. We know the space has evolved so much every year. It's also a 24/7 industry. There's a saying in Chinese is that 币圈一天人间一年. It means that one day in Web3 is like a whole year in the whole world. So how do you envision the industry is going to be in the next 5 years, and what are the trends that you think we should be focusing on?
I think like the biggest trend will be more users at the application layer. I know like for a lot of VCs, infrastructure has been what made the most money in previous cycles. But if you look at how Web 2 kind of grew over the years, where you had infra application cycles, I think crypto is, the next round of crypto growth and evolution will be at the application layer, mainly because we need to have more people kind of get engaged in this space, right? If you look at all of the applications that have come in crypto, I think the biggest one today is probably DeFi. Tens and thousands, hundreds of thousands of users in DeFi, internet money, and I think right now, like apart from DeFi, a lot of the social, a lot of the gaming still hasn't really taken off on a massive scale, mainly because the difficulty of creating a wallet, right, for many of the more general users, managing your own keys. A lot of this stuff has made a lot of this onboarding easier going forward. So I think for one of the biggest theses that we have at Foresight is as this space grows, we're going to see a lot easier onboarding of users, making like more composability between a lot of these protocols, a lot of these applications. So therefore, like we hope to kind of see more people coming into the space and just leveraging applications and playing around in crypto.
To be frank, I start to see a little bit of this in Web3, right? People are going around inventing new narratives. Maybe it will help, maybe not. Though, one thing is for sure in my mind is that we don't nearly have the scalability or interoperability that it takes to really build highly scalable applications, right? So I still think down the road, right, in the near future, 2 to 3 years, 5, even longer, there's ample room for infrastructure investments, though the creation of these infrastructures might be driven by applications, because what tends to happen is people would build really good applications that consumer would use, and then it will break the infrastructure that it's hosted on, right? And therefore, it will cause the infrastructure to evolve. However, I think liquidity is king, right? Whoever gets the most liquidity will get the most user. DeFi is definitely going to be one of the hot topic, even though less and less people talk about DeFi these days, because that's not because no one's building DeFi, it's because DeFi has matured relatively to other types of application, and it's going from the application layer to the infrastructure layer, right? So if you talk about TradFi financial systems, people don't talk about which exchanges is the best, or which exchanges have the best execution. People talk about what products they're building. So it's a sign of maturity, though I still think there is a huge gap between what is an acceptable amount of infrastructure that could power Web3 versus what we have today. So, I generally think there is still going to be a lot of opportunity in the infrastructure space.
I kind of think this is a terrible question to ask VCs, because I can tell you, knowing VC, like I've been investing in the space since 2017, and I know a lot of the top VCs. I can tell you, we had no fucking idea what was going to happen. We did not predict DeFi was going to blow up. We did not predict NFTs. We did not predict how any of this stuff was going to happen. So now coming to VCs and be like, hey, what's going to happen in 2025? I think the answer is that we don't know. We don't know any more than you guys do. I think what the job, this is often what I tell my team at Dragonfly, is that your job as a VC is not to predict the future, because nobody can predict the future. And you can just look from their track records that everyone sucks at it. The thing that you can do is you can notice the present. You can see the things that are happening in these small little pockets of innovation, right? These people who are sort of in proverbial garages tinkering with new ideas. And you can see which of those ideas are starting to gain just a little tiny little iota of traction. And if they are, then put more energy into it, nurture it, see what it can become. That's what a VC can do at their best. But the reality is that when you're looking at a disruptive technology like crypto, like Web3, like what are people going to do with smart contracts in 3-4 years? I don't know. I did not predict that they were going to do NFTs. I saw CryptoKitties back in 2017 when it first started, but the idea that there would be this massive boom that celebrities and agencies and these NFT issuing art houses were going to come up, that Nike was going to be issuing NFTs, I had no idea that any of that was going to happen. And so the thing about technology like this, the same thing that happened with the internet, is that when the internet first began, you could tell that this was important. You could tell the internet was going to do new things, but there's no way you could have guessed that once we had the internet, that there would be no more taxi cabs in New York City. That the computers were going to, phones, and then Uber, and then all these things were going to completely disrupt the way that people move around in the world. You could not have predicted that. And so the nonlinearity of innovations that are open and permissionless, like crypto, make it really difficult to predict the future, which is why, for a question like this, I'm just like, I don't know. But I do know that it's going to be very different than what anybody else can predict, looking at what's here today.
It's like WeChat didn't predict that the app that's going to steal their users' every time spending on their app is TikTok. It's a completely different format. So I think I agree to some extent that the next killing app is something that probably we've never seen before. And that's very interesting. Okay, so my next topic is around regulations. So we know on the regulation space, it actually involved a lot. A lot of things happened this year, especially Hong Kong leading the way, right? Hong Kong has given out retail exchange license, and they classify NFT as a commodity, approve ETP ETF, and we're all waiting for the approval for spot ETF from the States. So whenever regulations actually happens in the industry, it's going to be a very good and firm fundamental. It's going to be a firm foundation to attract more institutional capital and more talents into the space and more builders, right? So what opportunities do you think is going to bring in with the regulation framework getting more mature, whether it's CFI again, RWA? What's your thoughts on this?
That's a good question. I mean, regulation is, it's mostly something that matters more to entrepreneurs and it matters to institutions. It doesn't matter so much to retail. Retail doesn't really care if things are regulated or not. But you can sort of tell because in the bull market, obviously none of this was regulated, and retail just showed up and was ready to party. And retail is not going to show up just because, oh hey, there was a law passed in some places. Oh great, now I'm going to buy Now I'm going to go buy some Dogecoin or whatever. If you're hoping that regulation is going to save you from a bear market, I have bad news for you, right? Probably to get out of a bear market, you need more than just good regulation to get past. Good regulation is kind of just a baseline.
Bitcoin was invented to kind of empower true ownership, right? Well, what that means really is, well, you have your money, no one can take away your money from you, right? Assuming that you have the proper key setup and so forth. And Bitcoin was born out of certain historic events and people's unhappiness towards the TradFi system, right? So it was never designed with regulation in mind. As a matter of fact, I would argue, is regulation resistant, right? Meaning, as long as you don't disclose your private key, you hold the asset, right? DeFi, same thing. Code is law, and therefore, it's very difficult to regulate. Though, I would argue, most of the tragic events that have happened in crypto, whether it's good for the ecosystem or not, are caused largely by CeFi entities. So I think a clear regulation on how CeFi entities operate would generally benefit the entire ecosystem. But then again, USA is just one country out of the entire world. Having the ability to enforce within the US and largely throughout the globe is nice, but we still lack the global clarity of how we reason about CeFi entities, right? But again, like I said, it's a very tricky topic because the core technology itself isn't that regulation friendly, but then there's all the ancillary environment and players that could be regulated. And I think we should start with those first and then go from there.
Yeah, I like this question because this is a question we think a lot about, right, as an exchange. Any industry, regulations always mean that the industry is maturing to a stage where regulators see that, we can't keep having a wild west of crypto anymore. We need to figure out ways to kind of, their arguments would be to protect investors. Make it safer for participants in the industry. But I think for regulations in this space, the biggest thing that it will create is it will make the current established players more dominant. Because regulation is very, very expensive. You need to have very large compliance teams. You need to have constant communication with regulators. You need a lot of operators at the exchange that help deal with these tasks, right? Make sure like all the KYC, AML is all up to date. Make sure that exchange technology is operating in a regulated way, meets all the standards of these regulations. So I think like regulations in a sense will cripple innovation in the CeFi space. Not necessarily in the DeFi space, but regulations will make new upcoming CeFi companies much more costly to grow. And it will also benefit current established players that want to ultimately become compliant, right? If you look at all the exchanges today, I'm pretty sure all of the big exchanges, like if you look at Binance, OK, Bitget, Bybit, they're all spending a lot of money building out compliance teams, trying to get licenses in other global jurisdictions, figuring out how to kind of operate for the future, because a regulated world in crypto is definitely the path that most of us see going forward.
Great. What advice do you want to give to founders who are looking to build a Web3 startup? Let's start with Tony again.
Yeah, so really quick, I think the biggest thing that founders should think about today is whether your problem is, whether your project or your idea is solving a real legitimate issue, right? I think crypto, like leveraging crypto payment rails, leveraging crypto decentralized tokenomics, they solve a lot of coordination problems and payment problems and other other issues. So I think for founders today, whenever you have an idea, you should definitely think about how big this pain point is, and make sure and it's in a big enough market that what you're doing is worthwhile enough of your time.
Yeah, I've seen many great teams. We ended up passing, whether it's application layer, infrastructure, or gaming. I think one of the things is that we couldn't build conviction around the team because the team did not have foundational understanding of blockchain, right? So this happens more often on the application side, where a very Web 2-like team was assembled and they wanted to build on Solana or Ethereum, but they didn't really have the foundational understanding of what they're using and why these technologies exist, right? Because I think Web3 is inherently different in the sense that, no, it's not just it's decentralized, but there's a reason that these technologies were born in an inferior state compared to traditional tech, right? Whether it's from speed, scalability, or user experience perspective. So there's a reason why you want to build in Web3, and that's very important to us because we need to see that you have conviction in the core technology that you're using. So the advice would be, if you want to build something grand, you probably want to have a very foundational understanding of how things work and why they exist.
So the advice that I would give to a founder, very briefly, is that I think the worst startups are startups that are building to solve a problem that was really acute 1 to 2 years ago. These startups almost never work because they're kind of too fixated on what was a problem in the last cycle. Okay are the startups that are trying to solve a problem that's there right now. But the best startups almost always are trying to solve a problem that's like 1 to 2 years in the future. And they can see it coming, and they realize that it's big, and by the time their product is ready, the market is also ready to accept it. Those startups almost always are the ones that end up becoming really, really huge. So that's OpenSea in 2018, it's Uniswap in 2019, it's looking at Solana, we started building basically in the last bull market. If you see this inflection point coming on the horizon, that's the best time to start building for something that's not yet here.
Great. Round of applause for my amazing panelists.